Assalamu alaikum friends, welcome to IFRS 9. This is the fifth part of IFRS 9 and we'll be talking about investments in debt instruments. In the earlier four parts, I have discussed financial liabilities, compound instruments, financial asset, equity instruments. This part will be considering on debt instruments, financial assets which are debt instruments, how to deal with it. Financial assets that are debt instruments can be measured in one of the three ways. Amortized cost, fair value through other comprehensive income, and fair value through profit and loss. But before that, we need to know what is debt instruments. Okay, debt instruments are assets that require a fixed payment to the holder. Fixed payment means because if you are holding that asset, you'll be receiving fixed payment, such as interest. Interest is fixed. One example of debt instruments is bond. Bond is a good example, very good example. Okay, because when you are holding bond, you'll be receiving interest as well as the principal amount, the bond amount. So let us go to amortized cost. And if you have been through financial assets and financial liabilities, you know that for financial liabilities also, we can measure it at amortized cost and also fair value through other comprehensive income. So the similar measurements we also have for our financial liabilities also. But there is a little difference when it comes to financial assets that are debt instruments. Okay. So you can keep the example of the bond in your mind when we are going through this, because in this way you will be understanding the concept easy in a simpler way, right? You are having a bond, it's your financial asset now. Okay. So IFRS says that an investment in a debt instrument is measured at amortized cost if these two things are there, you can measure it at amortized cost. That means the bond, you are measuring your bond at amortized cost. One is you have to check the business model. You're always the starting point when even in your exam also in the scenario you need to see what is the business model of that company. So if the entity's business model is to collect the assets contractual cash flow, why to collect the assets contractual cash flow? Because the definition of financial asset, what is the definition of financial asset? You are collecting contractual cash flows. You are receivable for cash flow. You have the right to receive a cash flow, right? So here the business model is to collect the assets contractual cash flow. What does this mean? This is broken down a little further. This means that the entity does not plan on selling the asset. That means you are keeping that bond with you. You're not selling that bond. Bond means asset here. Prior to the maturity, before the maturity, but rather intends to hold it until redemption. That means if you are taking a bond, let's say you are taking for 5 years. So for that 5 years, you're not selling that bond. You are keeping that bond with you, and on that bond, you are receiving cash flows. Okay, you are receiving interest as well as the amount of the bond, the principal amount. If it is like that, if you are keeping that bond until maturity, you are using amortized cost. And the way we calculate amortized cost is very much similar to how we have calculated a financial liabilities. Okay. Now, next, but not any type of cash flows. What type of cash flows? The contractual terms of the financial asset gives rise to cash flows that are solely payment of principal and interest on the principal amount. It should only be the principal and the interest. If the cash flows you are receiving is not out of this two, something else only, then that is not considered as you cannot use amortized cost for it. Then you have to use some other method out of the other two, fair value through other comprehensive income or fair value through profit and loss. So what you need to remember is that when you're holding that bond until the redemption date, amortized cost. Okay, and the payments you are receiving only principal amount and the interest on that principal amount. One example is given so that you better understand. The interest rate on convertible bond, so they are talking about convertible bond here, is lower than the market rate. Okay, why? Because the holder of the bond gets the benefit of choosing to take redemption in a form of cash or shares. See, when you are converting the bond, After you are converting it, either you will receive in form of cash or you will receive in a form of share, right? That is the meaning of convertible bond. You can convert the bond to equity or cash. So you'll be receiving either in form of cash or share. Okay. But so that means this contractual cash flows is not only the principal amount and the interest amount. Therefore, this convertible bond, you cannot use amortized cost for convertible bond. You can use amortized cost just for the bond, normal bond you're holding until redemption. If it's a convertible bond, you cannot use amortized cost because the benefit you are getting, you might receive cash or shares at the end after converting the bond. So it's not solely your principal amount and the interest amount. That's why you're not using amortized cost for convertible bond. Now let us go to the second type, how we can measure our debt instrument. So an investment in debt instrument is measured at fair value through OCI if this is also same like the before one. There is only a slight difference between amortized cost and fair value through OCI. Where is it? Here, the business model involves both collecting the contractual cash flows and selling the financial assets. That means selling the bond. You will be selling the bond here. You can sell it. Okay, so for example, if your business model is to collect contractual cash flows and sell the financial assets, you cannot use amortized cost. You have to use fair value through other comprehensive income. If your business model is to hold the bond until the redemption, then it is amortized cost, not fair value through other comprehensive income. So here it is about collecting and selling. This part is added here. And selling financial assets in the other comprehensive income. What does this mean? This means that sales will be more frequent than for debt instruments held at amortized cost. You're selling. The frequency of your selling is too much. Okay. For instance, an entity may sell investments if the possibility of buying another investment with a high return arises. Definitely. If you see that you can buy another investment with a high return, definitely you will sell the current one and buy that one. Right? The contractual terms of the financial asset gives rise to cash flows that are principals and interest. So this thing is same like the before one. It should be only principal and interest on principal, the cash flows. The only difference is here that you can sell the financial asset. That's the only difference between the first two. Now, let us go to the third measurement, fair value through profit and loss. Okay, so if an investment is not measured at amortized cost, not measured at fair value through other comprehensive income, then it is taken under fair value through profit and loss. This is very much simple. So how will you know whether it is not taken under amortized cost or other comprehensive income? They will tell you. Okay, they will give you some hint in the case study so that you can read it and you will understand it, that this has to be used. Test your understanding will be doing at the end after I finish the debt instrument. Reclassification. A very important area is reclassification. You sometimes need to reclassify. Why? Okay, so financial assets. So when you are reclassifying it, before reclassifying it, financial assets are classified in accordance with IFRS 9 when initially recognized. Okay, what does that mean? That means initially, okay, according to the business model, this will be amortized cost, this will be under fair value through OCI, this will be fair value through profit and loss. Initially it is recognized. Then if an entity changes its business model, changes mean before they were just holding the contractual, they were holding the bond, now they want to sell that bond, they're changing their business model now. So earlier they were using amortized cost, now they need to change it to fair value through other comprehensive income. You see, you need to reclassify it because the business model you are changing. So if an entity changes its business model from managing financial assets, all affected financial assets are reclassified. Example, they've given an example. Example is from fair value through profit or loss to amortized cost. Okay. For example, earlier it was not classified under amortized, not under fair value through other comprehensive income. It was, so definitely it will go through fair value through profit and loss. Now they have changed their business model that they are going to hold the bond until maturity. So that means now they have to change to amortized cost. So from fair value through profit and loss to amortized cost. You see? And remember, this reclassification only applies to investment in debts. You cannot go and do it under equity instruments or financial liabilities. No. Only for investment in debt. Financial assets, right? Financial asset debt instruments. Now, measurement. So now how do you measure after reclassifying it? Again, the three methods: amortized cost, fair value through OCI, fair value through profit and loss. For investments in debt that are measured at amortized cost, what do you do? That means initially it was measured at amortized cost, now you are reclassifying it, then you are measuring. So the asset is initially, this is not the reclassification, this is the measurement. Okay, the first time we went through this was this. First time we were looking at the criteria to select it will be classified under which. Now we are going through the measurement, how to measure. Okay, so if it is amortized cost, asset is initially recognized at fair value plus transaction cost. Don't forget this. Here we are adding transaction cost. This is new. Whereas in the financial liabilities, it was not like that. Interest income is calculated using effective rate of interest. You'll be given the effective rate of interest and you'll be calculating interest income because you'll be receiving the income, the interest. If it is fair value through OCI, okay, here also same like amortized cost, fair value plus transaction cost. This one is also same, interest income. The only addition is here. At the reporting date, asset will be revalued to fair value. So when something is revalued to fair value, we know there will be some gain or losses. So that gain or loss is recognized in other comprehensive income. That's why it is known as fair value through other comprehensive income. Okay, but remember, not all items in OCI stays in OCI forever. Later in future, you might reclassify them to profit and loss. So this is one of such area. This will be reclassified to profit and loss when that asset you are selling it entirely. You're disposing, you reclassify it to profit and loss. Now, fair value through profit and loss. Here we are not adding transaction cost. Okay, here transaction costs are expensed. But initially, yes, we recognize at fair value. At the reporting date, the gain or loss will go to statement of profit or loss. It's simple. Now, note on loss allowances. This loss allowances will go in more detail in my next few videos. But for now, what you should know is that for debt instruments, that means for bonds, which are measured at either amortized cost or fair value through OCI. We are not talking about fair value through profit and loss, only the first two. If it is so, then a loss allowance must be recognized. How to calculate loss allowance, what is a loss allowance, we'll be going through this in detail in my next video. We're definitely not going to cover it here. So now, let us summarize everything. Investments in debt. So now, investments in debt can be measured in three ways: amortized cost, fair value through OCI, fair value through profit and loss. Remember, for amortized cost and OCI, you have to do a test, contractual cash flow characteristic test passed. That means you have to see whether you are receiving just interest or payment, just interest or the principal amount or something beyond that. What type of cash flows are you receiving? Just interest and principal? Then yes. Then next you need to check if they have passed the contractual cash flow test. Then next you want to see is the business model for both amortized cost and fair value through OCI. Amortized cost you will be holding until maturity. Other comprehensive income you will hold and sell. That means you are not holding until maturity. Okay, you'll be selling it. You'll be holding to maturity and selling. For fair value through profit and loss, if it is not measured either at amortized cost or either through fair value of OCI, then it is fair value through profit and loss. This is very simple. Now let us go to conceptual framework. Just give me a second. Okay. We always have to see whether it is consistent with the conceptual framework's measurement basis or not. Conceptual framework says historical cost and we can measure at current value. Historical cost in this case amortized cost and current value is the fair value. Okay. If you see when selecting a measurement basis, how do you select? What does conceptual framework says on it to decide on a measurement basis whether historical cost or current value? Conceptual framework states that relevance is maximized if it takes into account the characteristics of the asset or the liability. You have to see the characteristics of that asset or a liability before deciding whether historical or current value. Okay, and the way in which it contributes to future cash flows. So if you see, this goes very much in line with the IFRS definition. IFRS 9 says, IFRS 9 provides a good example of this. That means they are going in line with the conceptual framework because the measurement of financial assets is highly dependent on the reporting entity's business model. You see, whether you will measure it at amortized cost or fair value decides on what? Their business model of the entity. Next, if an entity's business model is to sell the financial assets in the short term, then the asset is revalued to fair value. Okay, then you cannot say, okay, use amortized cost. At each reporting date, and the gain or loss is presented in profit or loss. Measuring the asset at its fair value will help the users of the financial statements to more accurately predict the entity's future cash inflows when it sells the assets, right? What about the amortized cost? They reflect the present value of the future cash flows associated with the financial asset over its life. So this measurement base helps users to access the contractual cash flows that the reporting entity will receive from holding the financial asset until maturity. So that's it. Now we'll be doing test understanding. Before I'm done with this part, which is debt instruments. The next one will be impairment of financial asset, a very, 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 very important part. Because definitely, even I was asked a question on that impairment of financial asset. It's a bit tricky, and you need to do a lot of memorization. But you definitely need to understand, have a sound understanding of impairment of financial asset, because this is an area. If I'm just assuming that if they ask a question on IFRS 9, this is definitely an area which they might ask, impairment of financial asset. Test understanding 6 Paloma. Paloma purchased a new financial asset on 31st December 2003. The asset is a bond which mature in 3 years. Paloma buys debt investments with the intention of holding them to maturity, although on occasion sold some investments if cash flow deteriorated beyond the acceptable levels. The bond pays a market rate of interest. Finance director is unsure as to whether this financial asset can be measured at amortized cost. Advise the finance director on how the bond will be measured. Okay. So now you are going to, from IFRS 9, you are going to list down the criteria that needs to be met before you can measure a debt instruments at amortized cost. Okay, these are the 2 points. First, you need to hold the financial asset to collect the contractual cash flow, right? You cannot sell it. Rather than selling it to realize the fair value changes, you cannot sell it, you have to hold it. Number 2, the cash flow should be solely principal and interest based on the principal amount. So in this case, the objective is to hold the financial asset and collect the contractual cash flow. Making some sales, they have made some sales when cash flows deteriorate does not contradict this objective. Even though they have made some sales, it does not contradict the objective that they want to hold the financial assets until maturity. The bond also pays a market level of interest, and therefore the interest payments received provide adequate compensation for the time value of money or the risk credit associated with the principal amount outstanding, right? So this means asset can be measured at amortized cost. Second, on 1st of January 2001, Tokyo bought 100,000 5% bond for 95,000. Incurring issue cost of 2,000, interest is received in area. The bond will be redeemed at a premium of 5,960 over nominal value on 31st December 2003. That is after 3 years. Effective rate of interest is 8%. The fair value is given on 31st December 2001 and 2. Explain with calculations how the bond will have been accounted for over all the relevant years. If so, these are the conditions. Tokyo's business model is to hold bonds until redemption. Next one, they hold bonds until redemption, but also to sell them if investments with higher returns become available. That means they are holding and then they are selling. Third, their business model is to trade bonds in the short term. Assume that Tokyo sold this bond for its fair value on 1st of January 2002. The requirement to recognize a loss allowance on debt instruments held at amortized cost of fair value through OCI should be ignored in this case. But not in the exam. In the exam, definitely, if you have to calculate a loss allowance, you have to calculate. This is because loss allowance has not yet been taught in your textbook. That's why they are ignoring the loss allowance. Okay. So now, first one, you are holding until redemption. That means you have to use amortized cost. It's very simple. Okay. So when you are using the amortized cost, you are holding the asset until redemption. Always you need to write it that the business model is this. You always need to start by mentioning the business model and also the cash flow they are receiving, interest and the principal amount. So because the business model is until redemption, debt instruments will be measured at amortized cost. And how are you measuring the asset initially? Fair value plus the transaction cost. You see, so your fair value is 95,000 and transaction cost is 2,000. Okay, it is this plus this. Okay, initially, that is the initial value, fair value plus transaction cost. Now you need to calculate interest income. This will be recognizing profit and loss using what rate? Effective rate of interest, which is 8%. So how are you starting it? You have been given the brought forward balance, right? It is this. You start with 97,000 here. This is your balance, opening balance. Okay. And on that you are charging interest of 8%. That is your effective rate of interest. So you'll be adding it and receipt, the interest you have to pay. Okay, which is 5,000. How are you getting 5,000? Because it is 5% on 100,000. 5% on the cash. This 100,000 is cash. So 5% of 100,000 is 5,000. Interest will be 5,000 only. 5,000, 5,000 and 5,000 every year is deducted. Next year, this closing balance becomes the opening balance for the next year. And then again, you charge 8% on that and deduct 5,000. Third year, until it becomes nil. Third year, it should be nil. And remember, when you are going to the final year, there's a principal amount, okay? Principal plus interest in this year. Okay? What is the amount? The principal amount is 100,000 on that, and it was given at premium, issued at premium. What is the premium? 5,960. It was redeemed at premium, 5,960. This you need to add with 100,000 because 100,000 the nominal value and premium is 5,960. So it's 105,960. And at the end you should have nil. Even if you have some little very small figure, that is due to your rounding error. But you should take it as nil, even if you're getting it as a small figure. So in the year end 31st December 2001, what is the interest income? It is 7,760. This will be recognized in the profit or loss. Okay, and the asset will be held at 99,760, the carried forward balance for the first year on the statement of the financial position. Next year, again the same. This is the interest income. Okay, and then this will be the asset carried in the statement of financial position. And what about the third year? Interest income is 8 to 190, but you're not it's nil. You're not recognizing any asset, it's nil. Now we are coming to the second one, where you are holding the asset until redemption, but sales may be made to invest in other assets. So therefore, this will be fair value through OCI. So same here also, this will be same, whether OCI or amortized cost. Now, so that means you have to revalue every year your fair value of the asset, and the gain will be recognized in OCI. Okay, so you're starting with a brought forward balance of 97,000 that you have calculated here. Okay, next, interest. See, this interest will be similar to what amortized cost, because 8% only you're applying. Okay, 8 to 1. Okay, now receipt also, this also will be same, your interest, and this will be your total. And now you need to add your gain and deduct your losses if it's a gain. Closing, remember, this is given to you. Okay, the closing balance is given to you. What is it? This two. This two are your closing balance, 110 and 104. Fair value of the bond. Okay, this is given for you to find the gain or the loss. So 110. So this is like the balancing figure. This is a gain. Now this opening balance, sorry, this closing balance for 31st December 2001 becomes the opening balance for 31st December 2002. On that, okay, so this interest will be same, and then it's a loss because this balance is also given. Now again you are taking this here. Okay, this will be same, 100 plus 5960. This is the total after you add your interest and deduct your receipt, and this is the loss, and finally you'll be having nil. Okay, so the amount recognized in profit or loss as interest, this is same as amortized cost. Okay, so the interest income figure will be same as in part A. That means this interest income, this will be recognized in profit or loss. Okay, but the revaluation gain, this 10 to 40, okay, all this will be recognized in OCI. Okay, in other comprehensive income, and asset will be held at this, the closing balance on the statement of the financial position. Same for 31st December 2002. Interest income goes to P&L, revaluation loss goes to other comprehensive income, and this will be held in the statement of the financial position. 31st December 2003, interest income in the profit and loss, revaluation loss in other comprehensive income. Now we are going to the third one, if it is through fair value. Now you recognize at fair value of 95,000. You are not adding 2,000 because this transaction 2,000 is expensed. Okay, interest income would be same, 5% on 100,000, 5,000 only. This will be recognized in profit or loss. Asset would be revalued to 110,000 from 95,000. So the balance, it's a gain, 15,000. This will be recognized in profit and loss now, because it is fair value through profit and loss. So on 1st of Jan 2002, the cash proceeds of 100,000 would be recognized and the financial asset would be de-recognized. Okay. Just because the third one is, they have told Tokyo's business model is to trade bonds in the short term. Assume they sold this bond in fair value on 1st of Jan 2002. That's why we need to know on this date. We don't want for the 3 days. We are selling at this date. So on that date, because you are selling the bond, that means that bond you will not have anymore. That means you are losing on the financial asset. That means you need to de-recognize the financial asset. Right? So that's why financial asset is de-recognized, and that cash proceed you are receiving 110,000, that fair value. You'll be recognizing it on 1st of Jan 2002. Now let us go to the last test understanding for debt instruments. On 1st of January 2001, Magpie lends 2 million to an important supplier. The loan, which is interest free, which will be repaid in 2 years' time. The asset is classified to be measured as amortized cost. There are no transaction fees. Market rate is 8%. Loss allowance is highly immaterial and can be ignored. Explain the accounting entries that Magpie needs to post in the year ended. Which year? 31st December 2001 at the year end to account for the above. Okay. First of all, you should know that this loan is a financial asset because Magpie has a contractual right to receive cash in 2 years' time. This is the reason why it's a financial asset. So initially financial assets are measured at fair value. Okay. And market participants will receive 8% the interest on loans. Whereas the loan made to the supplier is interest free. That means it would seem that transaction cost has not occurred on the fair value terms because they are giving interest free, whereas in the market it's 8%. So it's not at fair value terms, the transaction. So the financial asset will not be recognized at the price paid of 2 million because it is not in the fair value terms. That's why you cannot recognize the financial asset also at the price paid 2 million as this is not the fair value. Because initially you have to recognize financial assets at fair value. If it's not fair value, you cannot recognize your financial asset at that price. So instead the fair value, you must determine the fair value. That means you need to find out the fair value now. How can you do that? This can be achieved by calculating the present value of the future cash flows from the loan, discounted using the market rate of interest. Okay. So this will be the amount at which financial asset will be initially recognized, 1.71. How? 2 million divided by 1.082. Why is it so? It's not 2 million 1.082. It is in fact that power 2 didn't come. Okay, it is 8 to the power 2 because for 2 years. So in year 0, if you want to bring this is in year 2, and if you want to bring this in today's term, the present value, you need to bring this back by 2 years. That's why this is power 2 and is 1.08 because market rate of interest is 8%. Okay, so 2 divided by 1.08 to the power 2. Now how are you going to do the entry? You need to debit that 1.71 in the financial asset. You credit where? You credit the cash 2 million because you have paid 2 million. And profit on loss. Okay, so you are debiting it. It's a loss. Okay, the balance, the difference is the profit or loss. The balance goes in the profit and loss account. Now, but subsequently it will be measured at amortized cost. Initially, financial asset is measured at fair value. You found out the fair value by using the present value, using the market rate of interest, which is 8%. Now what are you doing? Subsequently, you are going to measure it at amortized cost. So you start by this. Initially, you measured at 1.71. On that, apply 8%. Notice it. Okay, they haven't mentioned anything about the rate and all they didn't give you. So this will be your 31st December 2001's figure 1.85. Okay, so interest income, this 0.14 will be recorded where you need to credit this from your financial asset. Sorry, debit this into your financial asset because it will be added with this and credit in the profit and loss account. It's an income. Okay. Why you're not getting any receipt? Because it's interest free. Remember this 8% we are using to find the interest income, but when it's coming to the receipt, we are not applying 8%. It's interest free. That's why the loan is interest free. No interest you are charging on the loan. So no cash is received also during the period. That means no interest you are receiving. So financial asset will have a carrying amount of 1.85. This is the carrying amount. Always the year end is the carrying amount in the statement of the financial position. Okay. And by 31st December 2002, the next year, financial asset will have a carrying amount of 2 million. How? Because they told in the beginning that, okay, that they lend 2 million to an important supplier, and this will be repaid in 2 years time. You see, it will be repaid in 2 years time. That means on 31st December 2002 this 2 million will be repaid, even though they have not mentioned what is the impact on 31st December 2002, but in the answer they are showing you that it will be 2 million. This will be the carrying amount on 31st December 2002. This amount will then be repaid by the supplier. Supplier will repay this amount because they told in 2 years time this amount will be repaid. So that's it for debt instruments. Next will be impairment of financial assets. So see you in the next part of this.